Let's talk about something that can look, well, pretty scary when it happens, a full-blown market halt. But what if I told you these moments aren't a sign the system is broken? Actually, it's the opposite. It's a sign that a built-in safety feature is working exactly like it's supposed to. Okay, let's dive into this.
So, have you ever been watching the news and you see a headline that the stock market just stopped? No buying, no selling, everything frozen. It's pretty confusing, right? I mean, what does that even mean for the market to just hit the pause button? Well, that is exactly what we are going to break down today.
You have to remember, at their core, markets are driven by people. And people, well, we're emotional. Sometimes a piece of news or just general uncertainty can spark a wave of fear, and that leads to panic. This isn't about logic anymore. It's a gut reaction where it feels like everyone is rushing for the exit all at once. And that, right there, is where the real trouble can start. Now, these safety rules weren't just invented out of thin air. They were actually born from a crisis. Way back on October 19th, 1987, a day now known as Black Monday, global markets just went into an absolute freefall. The crazy speed of that crash showed everyone just how dangerous panic selling could be. So, in response, the US introduced the very first circuit breakers in 1988. Learning from that, India's regulator, SEBI, formally put its own market-wide system into place in June 2001 to stop a similar disaster from happening. So, how should we really think about these things? Honestly, the best analogy is to imagine the stock market as a super fast-paced, high-stakes game. When things get way too chaotic and the players start making reckless moves, what does a referee do? They blow the whistle and call a timeout. That's exactly what these market breaks are designed to do. The official name for this is a trading curb, but you'll almost always hear it called a circuit breaker. And its entire purpose is to interrupt that cycle of panic. It forces a pause, giving everyone from the huge institutions down to individual investors like us a moment to just step back, take a breath, process what's actually going on, and hopefully make a more rational decision instead of an emotional one. Now, it's really important to know that there are two main types of these halts. First, you've got price bands. Think of this like a referee keeping an eye on one specific player who's getting a little too aggressive. It only affects that one player, or in this case, a single stock. Then you have circuit breakers. This is when the ref stops the entire game because both teams are just playing recklessly. It's a market-wide halt and it affects everybody. So let's dig into that first type, the rules that apply to just one individual stock. This is actually the most common kind of trading halt that you're likely to see. This is handled by something called a price band. You can think of it as a preset daily range, basically a floor and a ceiling for one specific stock. The key thing here is that this range isn't just random. It's calculated every single day based on where that stock closed the day before. Let's use a really simple example to see how this works in practice. So say a stock closes the day at 100 rupees. If the exchange has set a 10% price band for it, that means on the next trading day, its price can only move between 90 rupees and 110 rupees. That's it. Any orders to buy or sell outside that range just won't go through. It's a hard limit. Okay, so what happens when the price actually hits one of those limits? Well, if it hits the maximum price, that's called the upper circuit. At this point, demand is so high that there are only buyers left, but nobody is willing to sell at that price. On the flip side, if it hits the minimum price, it's in a lower circuit. Selling pressure is just overwhelming and you have only sellers with no buyers willing to step in. In both situations, the price is effectively frozen. All right, so we've covered the rules for one player. Now let's look at the big one, the rules that stop the entire game. Market-wide circuit breakers aren't triggered by just one stock having a bad day. Nope, they get activated based on the health of the entire market, which we measure using a major index like the Nifty 50 or the Sensex. So if the value of all these huge companies takes a sudden, sharp nosedive, the system hits the brakes for everyone. This table shows you the specific rules for the Indian market. Now, don't get too lost in the numbers. The main thing to notice is that it's a tiered system. It reacts differently based on how much the market falls and, importantly, what time of day it happens. For example, a 10% drop in the morning triggers a longer halt than the same drop in the afternoon. Why? To give people more time to figure things out. And if the market ever falls 20%, well, that's game over. Trading is stopped for the rest of the day. Okay, so we understand the rules of the game now. But what does all of this actually mean for you as an individual investor when you see one of these halts happen in real time? So what should you do? Well, the most important thing, number one, is don't panic. Seriously, the system is doing its job. This pause is actually a gift. It's your chance to take a step back, figure out what news caused the halt in the first place, and reevaluate your own investment strategy without the pressure of a price that's dropping like a rock. It's the perfect moment to avoid that herd mentality and make a choice based on information, not on fear. So, to sum it all up, the main benefit of this pause is that it gives everyone time to think and digest what's going on, which helps prevent those catastrophic crashes that are driven by pure panic. But it is worth noting a little behavioral risk that experts point out, something they call the magnet effect. Sometimes, as a stock price is falling fast towards its limit, some traders, afraid they'll be stuck and unable to sell, might rush to dump their shares before the halt is triggered. Ironically, this can actually pull the price down to that limit even faster. This quote just perfectly sums up the entire idea. Think of price bands and circuit breakers as safety gear, like a helmet or a seatbelt. You hope you never have to use them, but you're sure glad they're there. They exist for those rare moments when sentiment threatens to completely take over and overwhelm logic in the market.
So, I'll leave you with this question to think about. After breaking all this down, does that sudden market stop still feel like a crisis? Like the system is failing? Or does it now seem a little more like what it was actually designed to be? A calm, collected referee calling a much-needed timeout in a game that was starting to get a little out of control?